How to interpret and analyze cash flow statement, income statement, and balance sheet, and how to combine different parameters to create ratios and analyze them. Namaskar, hello, and welcome, friends, to this advanced financial modeling, stock research, and valuation course. This course is for investors and finance students who are looking to understand how professionals value stocks. The course comes with a dual certification program. One is for the course completion and one is for internship completion. So, for those who are interested in enrolling to the course certification program, the details are given in the description and in the end of the video. You can check that out. Meanwhile, the entire course material is available freely on YouTube, like this video, so you can learn it freely anywhere, anytime. Students who are pursuing courses like MBA Finance, CFA, CA, CPA, MCOM, BCom have all taken this course and benefited from it. If you are an investor or if you are a finance student, this course is for you if you are looking to understand how professionals value their stocks. What is the eligibility for this course? The good news is we have structured the program assuming that the viewer is a beginner. So, from a beginning stage, if you do all the assignments and all the chapters one by one without skipping them and applying them hands on, then by the end of this course, you are assured to have an advanced level knowledge of how stock valuation is being done. And regarding the course content, let us discuss that now. First, we come to the stock filtration. Any stock exchange, if you visit, you will find that there are thousands of stocks. For example, Nasdaq has more than 3,000 stocks. NSE and BSE together have around 8,000 stocks. So, to begin with, we need to find out a way where we can filter out all these thousands of stocks and reduce the number to a manageable list which we can do deep analysis on. In the first assignment and first chapter, we show you an efficient way, an intelligent way of segregating the stocks and filtering them out. In the second chapter and second assignment, we try to understand how to interpret the cash flow statement, the balance sheet, and the income statement and bring them together to do ratio analysis. Ratio analysis brings us to chapter 3 and assignment 3. In chapter 4, assignment 4, we are going to study together in a detailed way how to do discounted cash flow valuation. Apart from that, we will also learn how to do dividend discount model valuation and residual income valuation. After learning how to do discounted cash flow valuation, we get into detailed reading of an annual report. We take a company which is listed in the stock markets and we read the annual report together along with you. After learning discounted cash flow modeling and valuation, we move into valuation of financial institutions, that is, banks, NBFCs, etc. The valuation of banks and financial institutions is a bit different than the typical manufacturing company or even an IT company. So we understand how to mathematically value a bank or a financial institution in this assignment. This is assignment 6, chapter 6. Assignment 7, chapter 7 is about understanding the monetary system and the currencies. We delve deep into the history of monetary system, the evolution of currencies, and the impact of central banking policies and the state's financial and monetary policies on the economy, especially during recession times. In the last chapter, that is assignment 8, chapter 8, we move into understanding the specific analytical parameters for specific industries and specific companies. For example, a mining company is analyzed differently than a retail company. A retail company is analyzed differently compared to an IT company. An IT company is analyzed differently compared to a banking company. So specifically, each of these industries have some specific parameters. We understand what those parameters are and how to understand them in this last assignment. And once all these things are over, the main goal is for you to become capable of valuing stocks like professionals do and creating reports like professionals do. So without further ado, let's get started. How to interpret and analyze cash flow statement, income statement, and balance sheet, and how to combine different parameters to create ratios and analyze them. Our assignments 2 and 3 are all about this. Assignments 2 and 3 comprise of 5 segments. In the first segment, we understand balance sheets. In the second segment, we understand income statements. In the third segment, we understand cash flow statements. In the fourth segment, once we are done with analyzing the financial reports, that is cash flow statements, income statements, and balance sheets, we get on with ratio analysis. And in the fifth and the last segment, we take a real listed stock and understand its financial statements and do its ratio analysis. Now, the third segment begins understanding the cash flows. You'll be really happy to know that the content of this segment is directly taken from CFA Level 1 curriculum. Let's get started. Let's start learning. A warm welcome, friends, to this new chapter called The Understanding of Cash Flow Statements. And it is part of CFA Level 1 and useful for any finance student from any domain. Here we try to understand the different sources of cash inflow and outflow and how they are categorized under both IFRS and US GAAP, and what is the significance of each of those items, and how an analyst can look at these items and try to decipher or make judgments about a company and its current status and its future status also. So friends, let's start our journey. Cash and non-cash items. So friends, in a profit and loss statement, for example, there are certain items like sales, then there is cost of goods sold, then there is financial expenses, then there is depreciation and amortization, and then there is taxes, then there is net income, right? Items proceed like this. Now from these, certain elements like sales, these are actually representing cash, right? Sales actually represents cash. On the other hand, depreciation and amortization is basically a non-cash item. Why? Because some investment has been done, say 5 years back or 1 year back or maybe this year. And this investment, let's say it is of 100 million, and the useful life of that asset where it is invested is 20 years, right? 20 years. Therefore, every period for these 20 years, each year 5 million will be added in depreciation and amortization. Instead of subtracting 100 million in the beginning only, what will be done is basically this item will be capitalized, which means the entire useful life will carry the cost of it in a distributed manner, which implies that this depreciation and amortization is a derived item. It's a derived item. It's not a cash item. It's a non-cash item. Similarly, an interest expense is a cash item. You have actually paid the interest, right? You have paid the interest. So it's a cash item. So like this, there are cash items and non-cash items both in balance sheet and profit and loss statement. Sources of cash inflow and outflow. There are mainly three sources of cash inflow and outflow. They are investments, operations, and financing. Now we will understand each of these items separately, friends. First comes cash flow from operations. Now, these are basically cash inflows and cash outflows with regards to operating activities. Let's take some examples. Let's take a few examples of cash inflow from operations. What can they be, friends? Cash inflow from operations. This is basically proceeds from selling the main products or services plus trading securities. These are basically sources of cash inflow from operations. Now let us take example of some cash outflows. CFO minus, that is cash outflows. This is paying salaries, finishing product from inventories, right? Converting inventory into a finished product, delivery of the product, marketing expenses, etc., etc. So these are examples of cash outflow from operations. Now one must remember, trading securities is different from buying and selling securities for investment, right? That falls into the investment category. The main difference is basically the intent and the time horizon. Trading securities is mainly looking at changing hands of the securities rather than earning some periodic income from it. That is the main difference. Now we will go into cash flow from investments. So friends, let us first discuss a few examples where there are cash inflows from investments, CFI plus. This can be selling of some asset, selling of some securities, selling part of the property, plant and equipments, selling a license, which is basically an intangible asset. These are examples of cash inflow from investing. A few examples of outflows: obviously buying assets, buying securities, right? Then buying property, plant and equipments, buying land and PPE, buying licenses or technologies, buying patents. These basically result in cash outflow. Sorry, I have mentioned the sign wrong here. This will be negative. So again friends, examples of cash outflow from investing: buying assets, buying securities, buying land, property, plant and equipment buying, buying licenses, patents, etc. These result in cash outflow from investing. So we are looking at long-term assets being sold or bought. That is creating what we call cash flow from investing. Now we will go into the next step, which is cash flow from financing. Cash flow from financing activities. So first let's take a few examples, friends, of cash inflows from financing. What can they be? Issuing debt, issuing bonds. They basically mean the same thing. Issuing an IPO, issuing an FPO, issuing preferred stocks to selected investors, issuance of qualified. These are basically sources of cash inflow from financing activities. The first two that we spoke about were pertaining to debt, and the other three, IPO, FPO, preference shares, these are basically equity examples. Now we will talk about cash outflows from financing activities. This can be stock repurchase. In US GAAP, dividends paid. Then it can be debt repayment, etc., etc. These are basically cash outflows from financing activities. You are repaying debt, you are repurchasing stock, you are paying dividends under US GAAP, that is considered a financing activity, like that. Now a few things we must take note of. Certain accounting changes have happened in IFRS. Because of these changes, it says that if there is a lease payment happening, there are two portions to it. One is the principal, another is the interest. The interest portion is basically an operating aspect, and the principal portion is a financing aspect. So this is a new phenomenon in IFRS. There are certain other nuances also in terms of differences. For example, if I draw two columns, IFRS and US GAAP, regarding interest paid, dividends paid, and interest received and dividend received, there are certain differences. For example, dividends received can be operating activities or investing activities under IFRS, but it is strictly operating activities under US GAAP. Dividends paid, it can be an operating activity or a financing activity under IFRS, but under US GAAP it is strictly a financing activity. Interest received can be an operating activity or an investing activity under IFRS. Interest received under US GAAP is strictly an operating activity. Interest paid under IFRS can be an operating activity or a financing activity, but under US GAAP, this is strictly an operating activity. So these are a few differences between IFRS and US GAAP, friends. A few more differences, friends. Taxes under US GAAP are considered under operations. Under IFRS also they are operations, but certain taxes, if they are actually related to investing or financing activities, if it can be established that they are directly related to them, then they can be categorized into financing or investing activities. In case of format, there is something called direct format of cash flow statements and indirect format. We'll get to that very soon, friends. But we want to highlight a little bit of the differences here. In both under IFRS and US GAAP, direct and indirect both are allowed. And direct is encouraged. Here also direct and indirect is allowed, but direct is encouraged. So this is a point of similarity, but when a direct method is used, that entails another statement or another explanation or reconciliation, which basically explains how net income has been translated to cash flow from operations. So net income has to be adjusted, and that adjustment has to be shown step by step, and we have to arrive at cash flow from operations. This reconciliation is needed when under US GAAP direct method is used. Majorly indirect method only is used. So now we will understand what is a direct method and what is a indirect method. Direct method and indirect method. So friends, in direct method, what happens is the CFO and its sub-elements, all its sub-elements are specifically mentioned, whether they have increased or decreased, or whether there has been inflows and outflows. So inflows and outflows both are mentioned separately for all the items under the cash flow from operations statement, right? In indirect method, what happens is we start with net income. First item we mention is net income, and then we make adjustments to it. Let's say increases in inventory, or increases or decreases in inventory, increases or decreases in receivables, unearned revenues. All these things are mentioned, all these adjustments are made, and then in the ultimate we arrive at the cash flow from operations. So both have their advantages and disadvantages, friends. For example, the direct method is more useful or more easier to understand and analyze for an analyst, because specific items, the source of them and the amount are mentioned in the sub-item list, right? They can make specific predictions and specific amounts are readily available. In case of net income, the advantage is that you understand how the net income has been transferred or transformed into the cash flow from operations. This is the basic difference, friends. The argument here is it is specific and direct, and therefore it is more preferable for analysts and investors because they can make projections around it very easily. Here, the argument is it is more logical. It explains all the reasons why the net income has changed with respect to cash flow from operations, why there has been difference between CFO and net income, and what are the adjustments that have been made to arrive at that. These adjustments are basically accrual accounting and cash accounting timing differences, right? Accrual accounting and cash accounting timing differences. So these differences are explained better in the indirect method. Most of the times the indirect method is used
by the companies, while there are cases also where the direct method is used. Now we will try to understand both the cases, friends. So friends, here I have the cash flow statement for Amazon Inc. We have started with net income here, right? Started with net income, and then adjustments to reconcile net income to net cash from operating activities. This reconcilement has been mentioned directly. Depreciation and amortization. This is basically a non-cash item. This is not a cash transaction that has happened, so this is added back. Then stock-based compensation. These are not cash items, cash outflows, so they are added back. These are basically stock-based payments that have been made to the employees or any other investor maybe. Non-operating expense income net. Non-operating expense or income net. This is subtracted because this is cash outflow. So here what has happened is non-operating expense and income. Here income has happened, therefore it is subtracted. Deferred income taxes. This is subtracted. Changes in assets and liabilities, operating assets and liabilities. Inventory. There has been an increase in inventory, which means cash has flown out, so that is subtracted. Receivables has also increased, which means cash has not come back, so this is subtracted. Accounts payable is positive here. See, accounts payable has increased means cash outflow has been reduced, so that means there is cash. Unearned revenue, that means you have received the cash, whether you have recognized it in the income statement or not, that is a secondary point, but you have received the cash. Similarly, accrued expenses and other, these are also added back. And after all these adjustments, you arrive at net cash provided by operating activities. This is basically the CFO. This is the CFO. So this is the indirect method in demonstration. So friends, here you can see this is basically the direct format of representation. Here there are specific items mentioned: cash received from customers, cash paid to suppliers, cash paid for operating expenses including research and development, interest received, interest paid, income tax refund received, income tax refund paid, other cash received. If you total them, you can arrive at the net cash flow from operating activities. So this is how the direct representation happens. So friends, here you can see that we have an income statement. We have an income statement here. We have a balance sheet which shows 2 years of data, 2023 and 24. This income statement is for 2024. And from these two, we have to derive the cash flow statements which are expressed in direct method. So this is expressed in direct method. Now how do we do that? Let us first see the items that are mentioned in the income statement and the balance sheet. As usual, you can see revenue, cost of goods sold, gross profit, salary, depreciation, other operating, total operating profit, other revenues. Other revenues have been divided into two parts, which is gain on sale of equipment and interest expense, income before tax, tax expense, then net income. Okay, so here this is the format. And in balance sheet, obviously we have started with the current assets. These are the current assets. Then we have gone into the long-term assets. Then total assets have been added. Then current liabilities, total current liabilities, long-term debt, different forms of equity, then total liabilities and equity. Now here there are two years of data mentioned so that we can judge the change. Why? Because that change itself is going to help us ascertain what is the cash flow. There is a difference between the cash flow and the income statement. That difference is basically measured through certain net change calculations in the balance sheet for 2 consecutive years. So this is how we do it. Now, in the cash flow statement, you can see there is cash received from customers, cash paid to suppliers, cash paid to employees, cash paid for other expenses, etc., etc. Now we have to calculate them. So first, cash received from customers. This is basically revenues plus decrease in receivables or minus increase in receivables. So you have to first see whether receivables have increased or decreased. Let's see. This is equal to, so this is first, let us write it. Cash received from customers. This is revenue plus decrease in receivables or minus increase in receivables. So here what is the case? Let us see that. In case of receivables, this is 2530 minus 2392. So there is a increase in receivables. So this can be written as or revenue minus increase in receivables. Therefore, this will be revenue minus increase in receivables. This is the value, friends. Then cash paid to suppliers. This is basically cost of goods sold plus increase in inventory minus increase in trade payables plus increase in inventory minus decrease in trade payables. Now this basically can be written in another way also. COGS minus decrease in inventory plus decrease in trade payables, or COGS plus increase in inventory plus decrease in trade payables. So if it's a decrease in inventory, then it gets subtracted. If it's a decrease in trade payables, it gets added. If the trade payables have decreased, that means more cash has gone out. If inventories have increased, that means more cash has gone out. So both things we add. If there is increase in trade payables, that means less cash has gone out than what is represented in the COGS. So we subtract it. Now here what is the case? Let's see. Inventory is equal to, change in inventory is equal to this minus this. So inventory has increased. And trade payables, accounts payable, this you have to again check. This is this minus this. So accounts payable has also increased. So what we'll be doing is we'll be adjusting the COGS because inventory has increased. So we will be adding because more cash has gone out than is represented in the COGS because of the inventory. So we add it. Because payables has also increased, so we decrease that payable amount, that increase in payable amount. Because that is basically the cash which has not gone out, which is shown by the figure of COGS plus increase in inventory. That is a figure which basically does not consider the increase in payables. So we reduce it by the increase in payables also. Cash paid to employees. Cash paid to employees, this is basically salary and wage expense adjusted for the change in salary and wage payable. So if the payable increases, you basically reduce that amount from the salary and wage expense in the income statement. If it reduces, then you add that amount. So here let's see what has happened. Salary and wages payable has increased. Salary and wages payable has increased. That means that much less cash has been actually paid in cash than what is mentioned in the salary and wage expense in the income statement. So what we do is salary and wage expense income statement minus increase in salary and wage payable, which is mentioned in the balance sheet, right? So this is what we do. This is equal to salary and wage expense minus increase in the payable of salary and wage expense. So this is the answer, right? Then cash paid for other operating expenses. This is basically going to need three elements. One is other operating expenses, which is mentioned in the income statement. Then we will need the change in the prepaid expenses, this one, and we will need the change in the other accrued liabilities. So if liabilities have gone up, that means less cash has gone. If expenses have gone up, that means more cash has gone. If expenses have gone down, that means less cash has gone. If liabilities have gone down, that means more cash has gone. So let's calculate it. Prepaid expenses. It will become clear when we do it actually. Prepaid expenses have actually reduced as per the balance sheet. So this will be a reduction to the other operating expenses in terms of cash. Liabilities, we want this to increase for reduction of the cash in cash paid for other operating expenses. Let's see what has happened. So this is equal to 2815 minus 2760. Obviously it has increased. So both will be subtracted. Actually this one will, the prepaid expense will not be subtracted because it itself is a negative number showing here. So this formula is given by other operating expenses minus decrease in prepaid expenses. That is the magnitude of decrease. Magnitude of decrease in prepaid expenses minus increase in other accrued liabilities. Increase in other accrued liabilities. So now we calculate the entire thing. Other operating expenses, we use plus sign here because this is a negative number already. This has decreased, so if we use plus, this will be subtracted. Minus increase in liabilities, other accrued liabilities. So this is the number that is coming, 8830. Cash paid for interest. This is basically interest expense adjusted for the change in interest payable. So we have to see whether interest payable has increased or decreased. So this is equal to 155 minus 185. Interest payable has decreased. So we have to add it to the interest expense in the income statement. So this is basically interest expense mentioned in income statement plus decrease in interest payable. This is from the balance sheet, right? So this is equal to interest expense. We use a minus here because we want to add the 30. Here it's showing a negative number, so we want to add it, so we use a negative. Negative becomes positive. 645. Now cash paid for income tax. Cash paid for income tax. This is tax expense adjusted for tax payable. First we find out the tax payable. Has it increased or decreased? So this is 137 minus 125. It has increased. So less cash has gone out than what is mentioned in the income statement. So this is going to be income tax expense that is mentioned in the income statement minus increase in income tax payable. So this is equal to income tax expense minus increase in income tax payable, which is this one. So we have our numbers. Now net cash provided by operating activities. This is equal to cash received minus all the paids. So sum of all these. 6515. This is the cash received from operating activities. Okay friends. Now we get into cash flow from investing activities. So this is basically divided into two parts: cash received from sale of equipment, cash paid for purchase of equipment. Now how do we measure both? Firstly, we find the historical cost of the equipment, then we find the selling price of the equipment, and we also adjust it for the depreciation. So friends, now we come to the cash flow from investing activities. Here the first item that is there is cash received from sale of equipment. Now there are certain steps you need to take in order to find it. We have added one note from the purchase of equipment. This is basically found in the notes, and we have assumed the number. Basically, the company has purchased an equipment at $3250. So this is the information. Now, using this and information from balance sheet and income statement, we have to find out cash received from sale of equipment, right? So purchase of equipment happened at 3250, and the ending balance that is the 2024 balance of equipment was 31995, right? So value of equipments after selling of the old equipment, this is equal to, if you wrap the text, value of equipments after selling the old equipment and before purchase of the new equipment, this is equal to this value minus whatever value for the purchase of the equipment was, right? This was the value, and the value of the old equipment was, if you want to find this of the old equipment, this is basically the equipment was there at the beginning of the year. So if you subtract this amount, that is without the equipment, whatever the asset item value, total value is, and with the equipment what the total value is, the difference of that is basically the equipment that is sold, the value, the cost of the equipment that is sold, not the sale price, the cost at which you acquired it. So this is equal to 21387 minus this 2642.5. This is the value of the old equipment. Now we have the value of the old equipment, or the cost of the old equipment, right, which was sold. Cost of the old equipment. Now what you can do is you can ascertain the depreciation adjustment to it. Depreciation adjustment. This is equal to change in the accumulated depreciation, which is basically, let us first find this. This is equal to this minus this. So there is an increase of 1380 in depreciation, and in the income statement there is a depreciation expense mentioned 2630. So the depreciation adjustment will be 2630 plus 1380. So this is basically the depreciation adjustment. This depreciation adjustment is basically on this equipment only. So therefore the net cost of sold equipment, or the old equipment This is equal to 2642 minus 1250, 1392.50, and there is a gain in the sale, right? So cost plus gain is equal to sale price, old equipment. This is equal to net cost of the sold equipment plus gain on the sale. This is 1905. This is basically the sale price of the old equipment. This is the cash received by selling the old equipment, 1905. Cash paid for purchase of new equipment. So we already have that. Purchase of equipment 3250. Therefore net cash is equal to, net cash for investing activities is cash received minus cash paid. Minus cash paid. This minus this. So this is our net cash from investing activities. Now cash flow from financing activities. Cash paid to retire long-term debt. This is equal to the change in long-term debt that has happened. So this is equal to this change, because no other information is available. This minus this. There is a change here. So cash paid is equal to exactly this. So this is, we will write it here. This is decrease in long-term debt. Cash paid to retire common stock. Because here there is no bifurcation made, right? Cash paid to retire debt, and there is no bifurcation that how much new debt was taken. There is no information regarding it. So we can directly use this. We can use the reduction in long-term debt and put it here. There is no other information available. Cash paid to retire common stock. Common stock was 10,875 and it got reduced. So what was the reduction amount? This is 9,375 minus 10,875. So this is 1,500. So this is again same. Decrease in common stock. There's no detailed information other than this is available. So we use this. Cash paid for dividends. Cash paid for dividends. So you can see the change in retained earnings, friends. This is equal to this minus this. 2725. 2725 was the change in retained earnings. So friends, we had made a mistake in the calculation of net income. This is basically income before tax minus tax expense, right? Minus tax expense. This is equal to 5525. 5525. So net income was 5525 and increase in retained earning was 2725. So easily we can find out the dividends, friends. It's basically net income minus increase in dividends, increase in retained earnings. So this is equal to 5525 minus 2725. This is equal to 2800. Therefore, net cash used for financing activities is equal to cash paid, cash paid, cash paid. So this plus this minus this, because this is showing as a positive number, we do a minus of this. So this is the financing activity net cash outflow that is happening. Now net cash increase and decrease. What we have to do is we have to see net cash from operating activities is positive, plus net cash from investing activities is negative, plus net cash from financing activities is also negative. So the net result is 380. Decrease of cash 380. If the figures are in millions, then it's 380 million basically. So let us calculate if the change in cash also reflects that. If this number reflects that, we have done all the calculations rightly. So initial cash is 2907. Final cash is equal to the initial cash plus the reduction of the cash. This is 2527. So this is exactly matching with 2527, 2907. So we have successfully converted the terms. We have successfully converted the terms given in the income statement and the balance sheet and converted them into direct method cash flow statement. So friends, like we did the solutions for direct method of cash flow statement, now we are going to calculate the numbers for indirect method of cash flow statement. As you can see friends, we have the indirect method of cash flow statement format here, and this starts with net income, right? Net income is there, then non-cash charge like depreciation expense is there, then gain or loss on sale of equipment is there, which is basically a non-operational earning or loss. So if it's a loss, it will be added back. If it's a gain, it will be subtracted. Then there is change in accounts receivable, change in inventory, change in accounts payable, etc., etc. One key thing we have to remember here when we are doing the calculations for change in receivables, inventory, prepaid expenses, accounts payable, etc., etc. The one key thing is that if there is an increase in something like inventory, or if there is an increase in something like receivables, that represents a net cash outflow. So increase in inventory, increase in receivables, etc. represents a net cash outflow. So the entry of that change value will be negative. Contrarily, if there is an increase in accounts payable, or if there is an increase in interest payable, or if there is an increase in tax payable, then that represents a net cash inflow. And likewise, they will be added as positive entries. The increases in payables and liabilities will be entered as positive entries, and the increases in receivables, inventory, etc. will be entered as negative entries. Now, with that being said, we start the calculations, friends. So first is the net income. It is clearly mentioned in the income statement. We directly entry it. This is a positive number. Then there is a non-cash charge, which is the depreciation expense. This is also entered as a positive number. Then there is gain or loss on sale of equipment. Now this is a non-operational item. So if there is a gain, we have to enter it as a negative number because it will be deducted from cash flow from operating activities. So here we see there is a gain. So we enter it as a negative number. Negative 512.5. Change in accounts receivable. Now we have to see if there is an increase or decrease, friends. Accounts receivable 2530 minus 2392.5. There is an increase of receivables here, friends. So if the receivables have increased, this represents a net cash outflow. So the entry will be negative. Same goes for inventory. Again, there is an increase. So this again represents a net cash outflow. This will be entered as a negative number. Change in prepaid expenses. Let's see if it has increased or decreased. This has decreased. So a change in expense has decreased. There has been a decrease in expenses. This means this represents a net cash inflow. So the entry will be positive. Change in accounts payable. Change in accounts payable. Again, we have to see if there is an increase or decrease. There is an increase. So this will be a positive entry because this represents a net cash inflow. Change in salary and wage payable. This is equal to change in salary and wage payable. First, let us see whether it has increased or decreased. This has increased. So a payable has increased. Obviously, this represents a positive number or a positive entry. Change in interest payable. $155 minus $185. The interest payables have decreased. So there is a net cash outflow. This will be entered as a negative number. Change in income tax payable. Let's see if there is an increase or decrease. There is an increase. So this will be entered as a positive number or a net cash inflow number. Change in other accrued liabilities. 2815 minus 2760. These liabilities have increased. So this represents a net cash inflow. So this will be a positive entry. Now we will be summing them up to get our CFO, cash flow from operating activities. 6515. Now we come to cash flow from investing activities. First line item is cash received from sale of equipment. This has to be calculated step by step. First, we find out the value of the equipments after selling of the old equipment. That is, value of the equipments that are left in the balance sheet after selling of the old equipment. This is equal to total equipment value minus the purchase price of the new equipment. So this is 21995 minus whatever price you have given to buy the new equipment. This is basically the value of all the equipments except the old equipment. Now we have to find the cost of the old equipment. The cost of the old equipment is basically value of the other equipments except the old equipment adjusted from the value of the equipments including the old equipment, which is 21387. This value includes the old equipment, and 18745, this does not include the old equipment or the new equipment. So if we subtract 18745 from 21387, what we are left with is basically the historical cost of the old equipment. So which is 2642. Now this is the historical cost. To find out the depreciation adjustment, we have to do more calculations. First thing we have to find out is the change in accumulated depreciation. Change in accumulated depreciation. This is equal to 1380. Now this value, if you adjust it from the depreciation expense for the period, what you are left with is basically the depreciation adjustment from the old equipment. This is equal to 2630 minus 1380. The depreciation adjustment is 1250, which implies that the net cost of the sold equipment, that is depreciation adjusted cost of the sold equipment, is 2642 minus 1250. 2642 minus 1250. This is the net cost after deducting the accumulated depreciation of that equipment, right? Now we have a gain on this. The gain is over and above this net cost. and the gain value is 512.5. So we add 512.5 with 1392.5. The net value comes at 1905. This is the cash received from sale of the old equipment. Cash paid for purchase of new equipment, we already know that, 3250. So this will be a negative entry because this is a cash outflow. Now we get the net cash used for investing activities. This is equal to 1905 plus negative of 3250. The value is negative 1345. So this is net cash used for investing activities. Now we come to cash flow from financing activities. First line item is cash paid to retire long-term debt. Cash paid to retire long-term debt. First we have to see if there is a reduction in long-term debt. 7867.5 minus 8937.5. There is a reduction and the reduction value is 1250. So this is the cash paid. So this is a cash outflow from financing activities. Entry will be negative. Cash paid to retire common stock. This will be, let's say if there is a decrease. There is a decrease 9375 minus 10875. So the decrease is 1500. Again, this is cash paid. So this will be a negative entry. Cash paid for dividends. Dividends is basically, cash paid for dividends is basically net income minus increase in retained earnings for the period, right? So let us find out first if there is an increase in retained earnings. This is equal to 9915 minus 7190. Yes, there is an increase of 2725. So 5525 minus 2725. This is equal to 5525 minus 2725. This is equal to 2800. But remember, this is cash paid, so this is a cash outflow again. So we represent it in a negative form. So this is negative 2800, which implies net cash used for financing activities is the sum of the above three items. 5550 negative. Now net decrease in cash. This is equal to CFO plus net CFI plus net CFF minus 380. There is a decrease in cash. Cash balance in 2023 is the beginning cash value. We adjust it for 380. So 2907 minus 380. The value is 2527.5. This is exactly the value mentioned here. Right? This is exactly the value mentioned here. So again, we have reduced the indirect method of cash flow statement from income statement and balance sheet. Congratulations. Now we discuss common size representation for cash flow statements. So friends, we can see a direct method statement here. Cash flow from operations, investing activities and financing activities are mentioned here. Now there are two companies, A and B, with drastically different numbers in terms of proportion are being demonstrated. For example, you can see cash received from customers is 80,929 million, and for B it is 557 million. So there is a lot of difference in terms of scale and size, right? So in such a case, what do we do? How do we compare between the two? Obviously friends, there is a way to do that. What we do is, in common size representation, we segregate the cash inflow sources from the outflow sources. So we write down the cash outflow sources separately and the cash inflow sources separately. Now it may so happen that what is a cash inflow for A is a cash outflow for B. For example, cash paid to retire long-term debt. This is a positive number in case of B, which means there has been cash inflow. While for A, it's a negative number. So this means they have retired debt, which means there has been cash outflow. Similarly, cash paid to retire common stock. Here there is a reduction for A, 2062.5. But for B, there is inflow, 41 million. So we have to deal it in this way. We have to mention it in both. And in case where there is no outflow, we mention just 0, because this will be 0 proportion. And here in the list of outflows, we bifurcate the magnitude of each of them, or we bifurcate the magnitude or the contribution of each of these line items in terms of percentages. Now first we calculate the total cash inflows and total cash outflows for A and B. Total cash inflows and total cash outflows. Okay, let us segregate it in a different way. So we use total cash inflows here and we use total cash outflows here. So what we were saying is, we indicate the proportion of contribution of each line items to the total cash inflow or outflow both, right? First, let us find out the total inflows for A. For A, the total inflows are 80929, 2619, and from cash paid to retire long-term debt and common stock, it's negative, so this will be 0, 0. So this is equal to this cash received from customers and cash received from sale of equipment. Rest is 0, 0. Now what we do, friends, is we divide this number by the total inflow. Similarly, we divide the second number by the total inflow. Now we can see it's a 96.8% contribution is from cash received from customers for A, and 3.1% is from cash received from sale of equipment. So we can convert it into percentages also, 97 and 3% approximately. Same thing we do for this one. So for B, the inflows are 557 plus 75 from sale of equipment plus 21 from debt and 41 from stocks. Now we'll be representing the percentages here. This is equal to 557 by 694. This is 80%. Sale of equipment 75 by 694, 11%. Debt from debt 21 by 694, 3%. From stock 41 by 694, 6%. So now we are in a position to compare, friends. 97% of the cash received in case of A is from customers while 80% is from B. Cash received from sale of equipment 3%, 11%. There is a drastic difference in both the cases. Now we come to the outflows. The total for outflows is 84070 for A, right? For A. Cash paid to suppliers. This is 40906 divided by this. So similarly, we can measure the remaining payments also from here. Is 17%, 14%, 1%, 5%. Purchase of equipment, this is this by this. 5%, 2%. We log the total value. Here we log the total value, then because there are consecutive negative values, we take advantage of it. So 2%, 2%, 5%. Common stock, dividends paid. Now we measure in case of B what is the situation. In case of B, the total outflows, this is equal to sum of the first 5 plus purchase of equipment plus dividend, cash paid from dividend. This is what is coming, right? Common stock and long-term debt, the contribution is 0 and 0. No point bothering here. In the other cases, obviously you can measure the amounts. Minus 231 by minus 508. Again, we lock the value and drag it for the 5 items because they are consecutive. We take advantage of it. So it goes like this. Only the first 5 items. So you can compare now. Let me also introduce the other 2 items that are remaining first. Purchase of equipment, dividends paid. So now we are in a position to compare. You can see here, friends, cash received from customers 97% for A in terms of inflows, while it is 80% for B. So the earnings quality for B is lesser than earnings quality for A. This is one observation we can make instantly. Next thing is cash paid to suppliers. They are pretty similar, 49% and 45%. Cash paid to employees, the second value 17% and 6%. This means B, in terms of its employee expenses or number of employees, whichever may be the case, it is quite tight in that respect. Other operating expenses, miscellaneous expenses 14%, 7%. So there also, in terms of other operating expenses also, B has been quite judicious. Cash paid for interest, in case of A it is 1%, in case of B it is 9%, which means financial burden on B is more than that on A. Cash paid for income tax 5%, 7%, pretty similar. Cash paid for purchase of equipment 5%, 22%. So obviously, because of this huge scale of A, one equipment purchase has much less impact than that of B. For B, it's a much bigger proportion of the total outflows, 22%, right? Cash paid to retire long-term debt and common stock, this is 2%, 2% for A, while for B, this is basically in the inflow. They have taken debt and they have issued stock. Cash paid for dividends, A has paid more, B has paid less, 5% and 3% respectively. So we can compare right now how the inflows and outflows balance each other. So this is how we do a common size analysis for 2 companies with different scale of operations. So friends, cash flow ratios. These are basically divided into 2 sections. One is the performance ratios and one is the coverage ratios. Performance ratios is basically about your margin percentages in terms of cash flows with respect to assets, with respect to revenues, etc. And coverage ratios are basically your ability to reinvest or repay your debt. So we will get into the specifics of each of them. First of all, let us define what is cash flow from operations. So cash flow from operations, friends, can be defined as net income plus non-cash charges, for example depreciation, minus increase in working capital. Increase in working capital, right? From one period to the other. This is the cash flow from operations. So having said that, we proceed to the ratios, friends. Cash flow to revenue. This is basically CFO by net sales. Obviously, you want this number to be high. Cash return on assets. This is cash flow from operations divided by average total assets. You want this number also to be high. Average total assets is basically assets in the beginning of the period plus assets in the ending of the period divided by 2. Cash return on equity. This is CFO by average shareholders equity. Average shareholders equity. Obviously, you want this number also to be high. Cash to income. This is CFO divided by operating income. You want this number to have some parity and balance. You do not want drastic difference between cash flow from operations and operating income for continuous periods. If there is such a difference, then this means there is a question mark in the performance. Cash flow per share. This is CFO minus preferred dividends divided by number of common shares outstanding. Number of outstanding shares. Debt coverage. This is CFO, cash flow from operations, by total debt. Total debt means interest bearing short term debt and long term debt. So obviously you want this number to be high. Interest coverage. This is equal to CFO plus interest paid plus taxes paid divided by interest. This multiple should be as high as possible, preferably. Reinvestment ratio. This is basically CFO divided by cash paid to retire long-term debt. Cash paid to retire or repay long-term debt. Investing and financing ratio. This is the ratio between cash flow from operations and cash outflows from financing activities and investing activities. So CFO divided by CFI minus and CFF minus. Cash flow from operations divided by the sum of cash outflows from investing activities, CFI minus, and cash outflows from financing activities, CFF minus. This is the ratio which is called investing and financing ratio. Then there is one more ratio which is called the dividend paid ratio. Dividend paid ratio. This is equal to CFO divided by the dividends paid. So that's it, friends, for this chapter of cash flow statements, understanding cash flow statements. We have covered a lot of ground in the last 3 chapters, which was about understanding financial statements, that is balance sheets, income statements, and cash flow statements.
So guys, congratulations on completing this segment. Let's move on to the next segment. The video is on your screen. Hope you enjoyed this video. If this video added value to you, please like the video and subscribe to the channel. Share this with a friend who is interested in finance and investing.